It was a wild day on Wall Street. The Dow opened down more than 500 points, then ended the day up almost 600 points. It comes amid what has already been a wildly volatile few days for stocks.
And joining us tonight to sort all of this out, David Caruso, Managing Director of Coastal Capital, who was with us a few weeks ago. And Dave, thanks for coming in again. And it was interesting when we were talking about the strength of the economy a few weeks ago. You said you didn't really see a correction coming, but based on the losses last week and the last couple of days, do you think this is officially a correction?
I'll tell you, we were worrying about Bitcoin last time. Now this is something to worry about a little bit. But I got to tell you, yeah, this is real coin, and this is our 401ks, and this is getting them in the right buckets. Yeah. In looking at where we are right now, I think that yes, we have had a correction. It's a 5% correction, and what's interesting about that, I think, the market's correct at 5% 3 times a year. So we should expect these things to happen. So we are seeing a correction. I don't think it's over yet. I still think there's more to come through. We've had a very good day today, but when I saw on Monday afternoon the volume that was going through, it was just staggering how quickly the shares were going through. I've never seen it like that, and we're wondering if the computers are catching up with that. So again, the technology's been pretty good. We haven't had another flash crash, but I think we got to keep a close eye on the computers to make sure, just like we're talking about Bitcoin.
How exactly does that work? One of the questions coming out of this is, why have we seen all this volatility? Last week we had a 300-point drop and a 600-point drop. Yesterday was an 1,100-point drop, and today you saw a 1,000-point swing. These computers play into this volatility. How does that work? Why is that such a problem?
What's happened in the last year, we had a year where the Dow was up 25%, and we had no volatility. It was just nothing was in its way. And all of a sudden, we had a great January, and then all of a sudden we're seeing, now we're competing with bonds against stocks. Now, stocks will do very well, but if interest rates go up, that actually hurts the bond market. So they're fighting with each other right now between stocks and bonds. So it's a battle that's going on, and we're worried about inflation. We've got a lot of noise with the Fed chief leaving. That can sometimes have effects on it. So there's a lot of noise out there, and we've got this thing with the budget coming up shortly. So there still is noise, and I think there's still going to be more that we're going to be running into.
Saw this funny cartoon tweeted out by someone from the New York Times, and it said, sad picture of one of those Wall Street traders, and you expected to see the picture of the guy with his head in his hands, but it was a picture of a bank of supercomputers. A lot of these trades are preset, right?
Yeah.
Does that accelerate what's happening?
They're algorithm. All of these big institutions are throwing trades out there, and they're putting them faster than they can, and we're going to have to catch up with that a little bit. I think we've still done a decent job, but it's not catching up to the volume, and because, again, you're talking about these big numbers, and when the trades come in, there's no way to turn.
We saw enormous losses last week and yesterday. We're still up 30% or so for the year. Are we done with these big single-day losses, or do you see more correction coming?
We're going to have a lot more volatile year this year than we did last year. We had an easy road to haul last year, with the good numbers. I think we're going to see more volatility. We have to see more volatility, and it's hard to say, but volatility can be your friend, because that's when there's opportunities. You should be buying when the market's down, but people do the wrong thing. They don't have good behavior. So, again, I think we're going to have a volatile year this year, more so than we were last year.
Always bears repeating, the stock market is not the economy.
Right.
That's right.
So what should the average person at home be doing, not doing, paying attention to?
It's called a 3-bucket approach. I really say there's 3 baskets that you have to look at. You have to have your money to pay your bills so that you know what you're doing. You have to have the things that you want to invest in or spend, I should say, in the next 3 to 5 years. And that long-term money, that goes into stocks. Because over long periods of time, if you look at every 5-year time frame since 1950, and you put it all into the S&P 500, you know what your worst rate of return was? A -2%. So keep for the long haul, not the short term. So get those buckets together and know a little bit, a high amount of risk, and in between.
Very quick last question. $1 trillion deficit is projected for the end of this year. Do you see that playing into people getting out of stocks and into bonds instead?
I don't think so. We've had this deficit thing going on since the 1940s. So my sense is I don't see that being a big problem. I think the tax laws are going to help, and I think the growth that's happening in the world right now, worldwide growth, and I don't see anybody looking for a recession. I think it seems to be wide open right now, so we got room to move.
Dave Caruso, thanks so much for coming in. You know what we are looking at? A lot of snow for tomorrow. So